the Lyon Share podcast with our host, Ed Lyon. Ed, how are you?
I'm doing great, Neil. How are you?
Fantastic. And when you told me what we're going to talk about, I'm like, yes, we've been waiting for this.
In the tax world, this is some big news. It's a big, beautiful bill that we got passed and got signed. And now those of us who are in the tax business, like my guest, Martin Eisenstein and I, we are fine-tooth combing through the big, beautiful bill to find the opportunities. So Martin and I are going to talk a little bit about the bill, but mostly we're going to dive in on a specific opportunity for business owners to potentially sell their business someday tax-free. And that makes a millions of dollars difference for the right business owner. So Martin, good afternoon from New Jersey. And let's start the conversation. I'm going to start with a mea culpa. I've been saying all year long that I didn't think we were going to see a new tax law until after Christmas, possibly after midnight on December 31st. My assumption was that the Republicans in Congress would have enough disagreement and people on either side of the issue, the anti-deficit side and the moderate side, would dig in their heels and we wouldn't be able to get a bill passed until we're listening to Christmas carols. And here we are in July. The whole thing is signed, sealed, and delivered. What are your thoughts?
I think it is, when you analyze it, not all that surprising. If you look at what's been happening this year, we've seen an erosion somewhat from what you could call the mandate or the power of the election victory, the popular vote win.
Sure.
The first 100 days, a lot of action taken federally, some of which has created hiccups. The tariff business has created hiccups. Some other things that are going on in the administration created hiccups. And I think the decision was made to push it through now, while the administration could threaten those people who didn't fall in line with losing their jobs in Congress. And it got done. And if I had to analyze it, I would say do it now. The longer you wait, the less chance there is to get it done.
By the way, Martin, I apologize for not introducing you. Neil Martin Eisenstein is a longtime friend and colleague of mine. He is a JD CPA, which is a really powerful combination, working with clients out of his base in northern New Jersey across the river from New York City. Martin has decades of experience in this business. He started in the talent management business and did tax returns for old school newscasters whose names you would recognize.
That's true.
So that's the way it is. There's your hint for Martin's old client. He and I have been in this space, in this tax reduction space for decades. And I think I can speak for you, Martin, when I say we're excited about one particular opportunity in the big, beautiful bill. Most of you who are watching this podcast are familiar with the headlines. You know that we've continued the 2017 rates. We've expanded the standard deductions a little bit. We put back in a larger state and local tax deduction. We've continued the qualified business interest rules. We've mainly kept things going and prevented them from expiring. There were a few campaign promises that Donald Trump made that are kept in the bill. Yes, there's no tax on tips, but only up to $25,000 of tip income. And if your spouse makes a whole lot of money and you earn tips, you're still going to pay tax. There's no tax on overtime. That phases out. There is not an elimination of taxes on Social Security, but there's a temporary extra standard deduction for some people on Social Security that will reduce their tax. But why don't you tell us what the one big opportunity is for business planners like us?
To me, it's the reestablishment and reset of the research, development, and experimentation credit.
That is important, and we're going to be able to deduct that faster. Also, we're restoring 100% bonus depreciation. We're extending the Code Section 179 rules. We're creating a larger Section 179 deduction. But what I really want to discuss today is the qualified small business stock, or Section 1202 provisions.
Absolutely.
So under the old rules, if you started a business as a C corporation and operated it for 5 or more years in certain industries, when it came time to sell the business, you could sell it tax-free up to $10 million or 10 times your basis, whichever is greater. Meaning if you had invested $10 million in that startup business, you could sell it for up to $100 million tax-free. That's a really big deal. And if your business was more than that limit, you could gift stock to your children. You could gift stock to multiple trusts with your children, your dog walker, and your dishwasher as beneficiaries. You could really spread around a lot of tax-free wealth. But the 1202 rules under the new bill are even more generous. So instead of having to wait 5 years to get your tax break, you can start getting it at 3 years or 4 years. Instead of a $10 million hard dollar limit, that goes up to $15 million. So we're really updating some of the limits for inflation since the rules were originally passed back in the 1990s. But it's a big expansion, and I think we're going to see a lot of people decide that they want to start their businesses as C corporations now, or, and Martin, curious to hear what you think, if they have an existing business that would qualify, they may be doing recapitalizations where they create a new C corporation, merge their existing business into it, create a basis, and now they've eliminated potentially tens or even hundreds of millions of dollars of tax down the road. So, Martin, tell me a little bit about some of your planning thoughts.
We believe that it's a lot easier to map out a successful exit from a business or part of a business over a 3-year window rather than a 5-year window. A lot of things can change in 5 years. You can adhere to a pretty close schedule. And what is the percentage of exclusion on gain if you hold the stock for only 3 years as opposed to 5? It's not the full 100%, is it?
No. So first of all, Section 1202 stock doesn't get the regular capital gains tax rate of 20%. It gets the special 28% capital gains rate, but you can exclude 50% after 3 years, which means you're at a 14% tax rate, and you can exclude 75% after 4 years. So we're gradually ramping it up, but 14% is still better than 20% for the right business exit. So it's an opportunity there. Neil, I see you're nodding your head. This is some really technical, this is really technical, weedy stuff. And I don't expect everybody who's listening to understand it. The lesson here is this is an opportunity. This is something that wasn't on the radar for the first half of the year when Congress was considering what they wanted to do. This is a provision that emerged from the Senate bill that the House ended up passing, and it really came out of left field for a lot of people.
I'm trying to understand it in certain aspects. I see that it's an opportunity to really have pretty much huge tax breaks to sell. It
Right.
sounds,
Sure, absolutely.
what about the Silicon Valley companies, these AI companies that are getting this huge evaluation? This is their opportunity big time for them with the money they're raising, like outrageously. You see the big time money that Facebook was paying people to leave one AI company to come to another, from OpenAI to Meta, and $100 million deals.
The kids who are geeks in high school are getting bigger contracts than the ones who are quarterbacking the football team or pitching for the baseball.
Yeah, it intrigues the heck out of me because really this is the geeks' last opportunity, especially when AI will take that opportunity away for them for good. But right now is an opportunity. So if you raise a lot of capital, Ed, and then you sell quickly, somehow there's an opportunity to make some money off of the deal, right? Is it true?
That's exactly it. If you raise a lot of money, you put it into a business. If you organize the business properly and you're in the right line of it. So this isn't something that you're going to do for a medical office or for an accounting firm. It's not something you're going to do for a bank or a motel or a restaurant. But for these tech companies or a lot of blue collar service companies, I work with a lot of clients who do things like excavation or tile or even landscaping. A lot of these companies, the owners are getting ready to sell. You've got baby boomers who are getting ready to retire. They're looking for buyers. Private equity is looking for these sorts of companies. If you set up a new business structure and roll your existing business into the new structure, you may have solved your tax problem when you sell your business. And that's where the opportunity, you don't need to understand the details. That's where guys like Martin and I come in with our clients. We look at the business, we look at what the opportunities are. We can tell you if this is something that makes sense for you or not. But we're going to be finding things in the one big beautiful bill over time. We're going to be finding mistakes in the bill. So the Republicans already say that they want to pass another bill through reconciliation in the fall. Reconciliation means it's not subject to a filibuster. Once they've found all the mistakes in the bill, they're going to be correcting those mistakes. I worked on Capitol Hill years ago, and the old school way of passing a bill was you draft it, you hold hearings on it, you have what's called markup sessions, where you're literally sitting in a hearing with a pen and you're drawing corrections. These bills these days, they're not passing with hearings. They're not passing with markup sessions. They're scrawled on the back of cocktail napkins from the monocle where the senators go to get martinied up before a big vote.
And I would make this comment. We can look at specific new aspects of the big, beautiful bill. But one important thing that needs to be said about its passage is it extends the last 10 years. A lot of planning has been done over the last 10 years, established, developed, and worth continuing, except that accountants, lawyers, and their clients said, what happens when this whole thing ends at the end of 2025?
Sure. What happens when the music stops?
The music's not stopping. And the techniques that are tried and true that favor business owners are there. They've been magnified by these provisions that you've mentioned having to do with the shorter holding period. And it just lets business owners sell not only their business tax-free, but to sell part of their business tax-free, which is an opportunity that people don't often think of, but leads to some very nice results.
Sure. And when somebody's selling a business, and this can be, it could be a small town dry cleaner, it could be a big tech company in Silicon Valley, people tend to look for one weird trick that's going to melt away all their taxes. The 1202 is the closest thing there is to one weird trick that melts away taxes. But what most business owners don't know is that they can divide up their business into pieces. So maybe part of your business gets sold through Section 1202. And if that's not enough to cover everything, maybe another part of your business goes to a charitable remainder trust or an intermediated installment sale, or you roll part of your gain into a qualified opportunity fund. Most people that I work with have multiple goals. The baby boomer who's 65 and looking to sell their business, they may have charitable goals. They may want to set their children up with a business. They may want to finance their kids' college education. And we can target tax strategies for each of those goals and do that rather than just have one strategy with particular strings.
So, Martin, this is good news, but really you need people like yourself and Ed to go through the weedness and not just with a whim, understand why selling, because there's so many businesses weren't looking to sell till now this came out, right?
I'm not sure that this is going to spur a new supply of businesses for sale. Part of the problem is there aren't enough buyers for businesses right now, especially for those blue collar, boring businesses that somebody's been running it for 30 years, but there isn't a child who wants to be in the business because dry cleaning is glamorous. And there isn't some 30-year-old zillennial who's looking to buy that business because dry cleaning isn't glamorous. So there are businesses, profitable, established businesses that are going to end up just going out of business because there's nobody to buy them.
Oh my goodness.
And I think what the Section 1202 rules are going to do, it's going to spur a discussion of what some of the possibilities are. And that may bring more people who want to buy a business. But I've started businesses, and starting a business is hard. Neil, you're in the business of podcasting. That's a tough business to break into. There are a lot of people out there who think I'd like to own a business. They think the only way to do it is to buy an existing or is to start a business, when if you're willing to buy an established business, it may not have the sex appeal, but it's already there. It's running. I don't know what the latest stat is on business failures. Something like 90% of businesses fail within 5 years. It's
And
crazy.
how many even profit?
It's nuts.
Really,
So why not find ways to buy existing businesses that already have the customers, already have the reputation, already have the 5-star reviews on Google?
I don't, because there's so much work involved.
There's less work involved in buying a business usually than there is in starting one from
Sure.
scratch. Martin, I know you work with business buyers and sellers all the time. Are you hearing anything yet? Any sort of fallout from the big, beautiful bill, or are people just dazed and confused at how fast it passed?
What I'm hearing from business owners is that they are relieved that they can continue the path of planning that they've been following. For business owners who haven't yet addressed this exit issue, because earlier in my career, I dealt with news people and verbal people, I've tried to make these tax concepts non-technical and tried to make them not involved with numbers that you had to roll around in your head. Any kind of business owner, and if you think of the example of somebody putting a package of mortgage securities together that nobody will buy because the default rates are too high. Now, if you just cut out some of those mortgages that are not good, you got a package of things that can be sold. Every business owner, a $5 million business, has $1, $2, $3, or $4 million of solid business, and the rest of it not so solid. And if the business won't sell for whatever reason, there's an asset in the business, a particular thing the company does, or a particular location that can be sold. And when that's split off in tax compliant ways, that part can be sold tax-free. Takes a good amount of planning, and there's some cost and risk involved, but the result is you could sell part of your business tax-free, keep the rest of it rehabilitated, and go on and be a lot more close to financial independence than if you didn't have a creative tax pro. So I'd like to say that Ed and I are an example of today's advisor. We are financial advisors, but we don't focus on the stocks and bonds aspects of it. We focus on the business aspects, the tax aspects, the legal, and the operational, which is important because people out there are not focusing on that to the extent that they should.
You make a really good point about the businesses that have the good operations and the not so good operations. And in a lot of cases, the whole may be worth less than the sum of the parts. So what you're talking about is you're breaking open the business and taking out the parts that are saleable now, maybe rehabilitating the parts that aren't saleable. But that's a discussion that applies to any size business. There's a lot of talk about Google. The federal government is suing Google for antitrust. There have been a lot of discussions about Google and some proposals to break Google up, because if Google as a whole is dragged down by some of the less successful parts of the business, maybe what we do is we separate it out. And so we've got Waymo and we've got YouTube and we've got the search engine business. The search engine business is declining because of AI. I've stopped using Google for search. It's so junked up with ads. I use AI. Neil, I think you and I have had this discussion. When was the last time you used Google?
So I still use Google because I like, but I'm not going to step on toes, but I agree with you. I use AI a lot more in my research, especially that ChatGPT or Grok. And I use Grok a lot because Grok gives real time and they're about to update there. I'm really excited. I guess I'm this tech nerd. 11 p.m. tonight, they're updating their newest roadmap that they're going to really start to catch up with OpenAI. And I think that the search is going to take Google. So you're using Google in a way, but AI is doing it for you and they're making that search right there. So you're right to a point, but Google's great also. I think Google, if it breaks up, then you better look at Mark Zuckerberg next and Meta. That's ridiculous what they're doing. They have too much of the market, and it's Hey, there's so many different things happening. We're in a different time period than ever. I'm a historian, and I have never in my life seen a time period where there's so much uncertainty for business owners or anything ever
And
because of AI, because of the tariffs, because of politically where we're at. This is a very uncertain time, and you basically got to just go with the flow and ignore all the noise.
you're right. And business doesn't like uncertainty. Martin, you emphasized that point a couple of times. Now, business owners understand that the rules are going to stay the rules, at least for a while, at least until the next time the Democrats control the White House, the House of Representatives, and the Senate, because nothing is ever permanent in Washington. But that sort of certainty, it's helpful. Sometimes it's not enough. So there is a provision in the big, beautiful bill that allows businesses to expense the cost of manufacturing facilities. And of course, it's one of the goals of the current administration to bring manufacturing back to the United States of America. So it makes sense then that if we're going to give companies a big tax deduction for building manufacturing facilities, that will help accomplish that. Now, there's other uncertainties that are going to work against that goal. The current tariff madness, when you have tariffs that are changing literally on a daily basis, I don't think that a tax deduction is going to be enough to get many companies to commit to millions or billions of dollars to building these manufacturing facilities. We'll see what ends up coming down the road. But certainty is a plus. Certainty helps grow the economy. It grows the economy faster.
Totally. So, Martin, thoughts on what are we missing in the big beautiful bill that has been covered not just in this podcast, but also that's in the layers and layers of the new bill?
There's a provision that doesn't really mean that much to people who don't qualify, but estate planning has changed due to the ability to give more than $1 million to each grandchildren that you have. There was a rule that provided for significant taxes if you were to skip a generation. So the ability now to plan for a piece of family real estate or a business that has become successful or a business that can't be sold or the change in administration where the tax will now come in at a much lower level, it should be looked at because you're planning for 10, 20, 30 years down the road, even if you're not subject now.
Well, the thing about the estate tax is nobody is subject to the estate tax until they die. The first thing we learn in wills and estates in law school is a will does not speak until death. And hence there's drama in lots of mystery movies about did the will get signed or did the will get updated or did the will get stolen? So that affects a very small number of people. The IRS only gets about 2,000 taxable estates a year, but those are big dollar amounts. So for someone who is fortunate enough to have that kind of a net worth, that's an important provision. And smaller things that will make little differences that add up. So charitable deductions, for years, they were available only if you itemized, meaning that your total itemized deductions were more than the standard deduction. Then in 2017, the standard deductions essentially doubled. The number of itemizers went from about a third of taxpayers to about 10% of taxpayers, meaning only that 10% could get charitable deduction. So Congress passed a provision that you could take what's called an above the line deduction on top of your standard deduction for charitable gifts. And it was $300 per single filer, $600 for married filers, joint filers. And now that limit goes up to $1,000 per single filer, $2,000 per joint filer. That's not a whole lot of money in terms of federal budgeting. It's not even a whole lot of money for specific filers, but if you have a larger number of people contributing to their local organizations, that's going to make a measurable difference, especially over time. So with any big tax bill, whether it's this particular big bill or others, we see spillover effects over time. We see things that we might not have thought would be that big a deal or that we didn't think many people would take advantage of. And 3 years, 5 years down the road, we find that people did take advantage of it and they start to count on it. And now it's something that we can't take away from them. And that's why the political context is so important. So Martin, you and I have both mentioned what happens with the next administration. A couple of years ago in 2022, Congress passed the Inflation Reduction Act. That included authorization for $80 billion in new funding for the IRS. And anti-tax activists seized on that and distorted it. They said, oh, the IRS is going to hire 87,000 new gun-toting agents. You remember that, Neil? Somebody on one of your podcasts talked about that. The reality is not nearly so scary. The bill authorized the IRS to spend money to hire 87,000 people over the next 10 years, most of them replacing the bureaucrats who are going to retire in those 10 years. The IRS only has about 2,000 special agents who sometimes carry guns. There were never going to be 87,000 new agents. They were never going to be toting guns. They were never going to be knocking down grandma's door to tax her. And very quickly, that funding started getting taken away. And that $80 billion it's about as real as the tooth fairy. It's simply not going to happen. So a lot of the things in this big, beautiful bill might get taken away. The changes to Medicaid, they're not specifically tax changes, but they don't kick into effect in some cases until 2028 or even 2030. Things like Medicaid work requirements and stuff. They may not end up coming to pass. So for tax planners like Martin and I, we can't just look at the tax rule. It's the old Wayne Gretzky quote, I don't skate to where the puck is, I skate to where the puck is going. And for tax planning, we got to look at where taxes are likely to be down the road. We've got to have our eyes open to all of that stuff. And it's great because it means you can do a tax plan now and you got to come back in 3 or 4 years and do another tax plan. And as I say to all my clients, now you know why tax lawyers drive Jaguars.
So when you were a tax lawyer, did you drive a Jaguar?
I did. I don't now.
I can't fit in a Jaguar, I don't think. It's 6'10".
You're a large guy. You're what, 6'10"?
6'10". Yeah. I don't think so. But like you said, it's so complex. It's so difficult to look at these things. And I think it's good news that the IRS, that's not happening, or that it's not going to be and lowering. Do you see as many audits happening?
No, I mean, with the budget cuts, with DOGE and the budget cuts, so the IRS is moving from enforcement by manpower to enforcement by technology. And if we can just drag the IRS technology into the 20th century and bring in tools like artificial intelligence, can look at tax returns and do a better job of spotting deviations or irregularities that can suggest that they're a worthy audit target. And I think that's a goal that most Americans support. If we can harness AI and other new technologies to enforce the tax laws, rather than having an army of bureaucrats, most Americans would prefer that.
And I think that's right. The IRS now has the tools to prevent people from not reporting their income because the income that they earn is reported by other sources. The IRS has tools to deal with people who make up deductions. What business people want is some certainty that the strategies that they're using to save on taxes aren't going to be challenged after the fact by some different administration, that they've done something wrong where the Supreme Court has said that it's not improper to plan to reduce your taxes. So business people want to know that if they're not evading their taxes, but they're taking advantage of what the law, that they're not going to pay for it down the road. And that's another advantage of having the playing field extended for another X number of years.
Ed, when you talked about AI, if they could just make it like kind of doing your own taxes on TurboTax and say, hey, you're in trouble. If you don't change this, you're going to get audited. If the AI, and we could just go right to the IRS and we worked with our accountant, but it was given and saying, you have a really good chance to be audited. You better go relook this over because AI showed it. It would tell us that. And then we move forward and go back to our accountant and say that, and it'd be less and less audits.
Potentially less audits. that's a decision for people to make. I tell clients never pass on a legitimate deduction, even if there are high odds of being audited. So people are often shocked at the most highly audited item in the entire tax system. And you're going to think, oh, it's offshore money or it's a kind of business deduction or something like that. It's the adoption tax credit, which is a credit for up to $15,000 of adoption costs. It's now refundable up to $5,000, which means if the credit is more than your tax, the IRS will send you a check of up to $5,000 on top of sending back all your tax money. But at one point, about 75% of adoption credits were being audited. So if there's a way that artificial intelligence can take over enforcement in that area without wasting human manpower, it's a $15,000 credit. Why is the IRS going after $15,000 credits when there have been court cases of literal billionaires fraudulently avoiding hundreds of millions or billions of dollars in tax? So it's priorities, it's technology. If I know that a deduction is likely to get audited, then I'm not going to say, oh, I'm not going to do it to avoid an audit. I'm going to say, okay, what is the hassle if I do get audited? How much am I going to save versus what is it going to cost me to defend my deduction? And maybe I do go in. But to your point, Neil, we're all going to be better informed.
Right.
We're all going to know more about what the likelihood is of getting audited, and we can figure out what the consequences are if a deduction is denied. The IRS is not going to eat you. You pay the tax, you pay some interest and penalty. People will tell me, I don't want to go to jail. I say, you're not going to go to jail. The IRS gets 250 million tax returns a year, and they initiate about 1,000.
I think you're more in trouble getting in trouble with the state than the federal government.
Certainly, depending on what state you're in, you're more likely to get in trouble with the state than with the IRS. But 1,000 prosecutions a year for the IRS out of 250 million. None of my clients have ever gone to jail. None of my clients are ever going to go to jail. I'm never going to go to jail. And as long as you are, for Americans, I think we want to be as proactive as we can in good faith.
Having worked in the entertainment business and having seen Wesley Snipes prosecuted, and having seen other famous people like Leona Helmsley prosecuted, you learn the IRS uses these minimal amount of prosecutions to remind the public that they are to be feared. It's the political thing. The other half of it is the Al Capone prosecution, in which the IRS uses its powers in conjunction with other law enforcement to catch difficult to catch criminals on tax charges. It's what the Republican administration has indicated that the IRS will be focused on partially going forward, which is a relief to business people who don't want to be improperly prosecuted for having taken a tax position that someone woke up not liking. So it's an interesting landscape.
Yeah, that's where the good faith comes in. So the real tax cheating is the stuff like the Wesley Snipes where, oh, I'm not subject to U.S. tax and I'm not legally required to pay tax. That's not a good faith position. And the IRS has made it clear. Congress has made it clear. The law makes it clear that's not a good faith position. But if you depreciate something more aggressively than the next administration likes, you shouldn't be prosecuted for that.
No, you shouldn't. And I think that there's a certain sense of fairness at the end of the day. But you did something, I guess, for another podcast, Ed, talk about when you get audited. Everyone says, don't get audited. It might make you more organized with your taxes after being audited, that you wake up and smell the coffee in certain aspects.
And you get through it and you realize, okay, the IRS audited me. That doesn't mean I'm going to jail. That just means somebody wanted to take a closer look at my return to make sure it was correct. About 10 to 15% of audits actually result in a refund to the taxpayer. Nobody ever talks about that. So the IRS audit is not the end of the world. The IRS is a collection agency for the government. They want you to be intimidated. That's why they announced celebrity prosecutions on April 15th. When did the IRS... I'm in Cincinnati, Ohio. So when did the IRS announce that they were prosecuting Pete Rose? It was April 15th. I believe they announced the Lyon Helmsley prosecution on April 15th as well. The IRS wants you to be on your guard. They want you to be intimidated. And I'm sure that they would love people not to take questionable deductions because that's a hassle for the IRS to enforce. It would be easier, obviously, if we had a much simpler tax code, or if we replace the income tax with maybe a progressive sales tax where it's collected at the point of sale. But every tax is going to create problems. If you decide to get rid of the income tax and replace it with sales taxes, then everybody's going to be going to blackmarket.com and doing their shopping.
And people have heard horror stories of other people who've gone into tax audits without a representative. They've been browbeat by the agent over all the things that they took that were wrong. The agent said, if you don't think I'm right, talk to my manager about it. And if they had talked to one professional, they would have said, these people answer to internal IRS. As soon as you appeal or go up the chain, you're dealing with people who have to consider both sides, and it's a lot more fair. So an audit is inconvenient. There are some costs, but it shouldn't stop you from claiming the tens of thousands of dollars that you're entitled to as a business person.
Never be afraid to claim a legitimate deduction. And one piece of advice, if your accountant tells you not to take the home office deduction because it's an audit red flag, you've outgrown your accountant.
Really? And people are doing that, Ed. That's crazy.
There are still accountants who advise their clients not to take the home office deduction because it's a red flag. They need to be put out to pasture.
There are accountants whose standard is to avoid an audit, not because it's not financially good for their client, because they don't want to handle an audit. They're afraid. And so they practice in a way that's a disservice to their client. They leave money on the table whenever return.
Sure. We hear that one of the problems with the American healthcare system is doctors are practicing defensive medicine.
Yes.
And they're ordering bazillions of expensive tests just to make sure that they don't miss something and get sued over it. There are a lot of people in accounting who practice defensive accounting when it comes to tax preparation. They just don't want to end up in an audit. I remember talking with an accountant years ago here in Cincinnati. Their firm said, we specialize in helping taxpayers identify red flags that may bring extra IRS scrutiny. And I thought that the name of this accounting firm should be Wussy, Wussy, and Wussy. They're just intimidated.
So define the difference between you, Martin, and Ed when it comes to working with a regular accountant.
Martin, you go first and then
Okay, so I think that there's a difference, and it has to be stated immediately, between a tax preparer and a tax strategist. A tax preparer prepares a return according to pieces of paper that is submitted and fills in boxes. A tax strategist first and basically only lead question is, what opportunities do we have to save you money, both after the fact on the return, where the year is already passed, and going forward?
Right. So I work with accountants across the country. I've trained accountants through my TaxMaster Network group, and some accountants are very proactive planners. It's clearly a minority of the group. And the ones who come to me, the ones who come to my group do so because they want to become better at proactive planning. They want to learn how to market that service. They want to learn how to fulfill that service. They want to learn how to deliver that service and do it profitably. So I'm happy to work with other accountants. I do it most every day. I just want to make sure that I understand where that accountant is coming from. If a planning client wants to keep their old accountant, that might work if their old accountant has the right mindset, a strategist versus a preparer mindset. But if they say, oh, my accountant is my father-in-law and he's really conservative and he won't let me do this and he won't let me do that and he won't let me do the other thing, I could probably prepare the best tax plan in the world and hand it to that client, but it's not going to get implemented properly. Yeah. And for those of you watching, there's a really easy question. One question you can ask that'll tell you what kind of an accountant you've got. And that question is, when was the last time your accountant came to you with an idea to save money? If the idea is never, that's a sign that you maybe outgrew your accountant.
And what about, Martin, when people that are not having an accountant at all to file their taxes? You've seen a lot of that too, haven't you?
I haven't seen that much of that. If somebody doesn't have an accountant, they're usually not a business owner or somebody who needs the kind of care that an accountant can provide.
That's a very diplomatic way of saying that. And I admire how you did that. Yeah, somebody who prepares their own taxes usually has a pretty simple tax situation. They're not necessarily in pain over the amount of taxes they're paying. They're in pain over the inconvenience of having to sit down on a couple of Saturday afternoons and go through those piles of paper with TurboTax. But they are usually not in a complicated situation that's presenting a whole lot of opportunity. When I was doing taxes for clients 20 years ago, I always loved when somebody brought me their TurboTax return and said, I'm ready for a professional. Because I knew as soon as I dug into the TurboTax return, I was going to find all sorts of mistakes and missed opportunities.
Wow. And that's the thing. And so you saw those mistakes and opportunities. And it's because TurboTax won't tell you, right?
No, TurboTax will tell you if the information you're entering is outside the parameters of what the information should be or something like that. But TurboTax is never going to tell you, hey, have you considered hiring your children, shifting income to be taxed at their lower rate, and then using that to set up a Roth IRA for your children? TurboTax is never going to say, hire your spouse, pay him with a medical expense reimbursement plan, and write off the cost of your daughter's braces as a business deduction under Code Section 105. TurboTax doesn't do that, and it's not going to do that. TurboTax will say, do you want to pay extra for audit protection or try to upsell you? But TurboTax, they're too busy lobbying Congress to not do IRS-free filing to actually help people pay less.
Interesting.
Which they were successful at, correct?
Yeah, which they were successful at. A little lobbying money can go a long way in America.
Let me throw something else to follow up on what you said, Ed. You have companies, let's say you've got a company that realizes we're not in the 20th century anymore. It's not on the marketing side, print, radio, television, and direct mail. It's digital marketing, social media, and 21st century. Company recognizes that they've got to make an effort in this area. Without a tax advisor, they might go ahead and just start spending money and hiring people. With a tax advisor, they might set up a separate company to manage this venture. That company could have the benefits that you talked about in terms of what a company can provide. And by some initial planning, they can end up paying thousands of dollars of taxes less at the end of the year.
Or you can move your intellectual property into a new company and lower the effective rate on that intellectual property. That's what companies like Google and Amazon do all the time.
And the business owner in the brick and mortar store in the US or the small operator can also do that because they have intellectual property. And it's one way of segmenting the business like we talked about at the beginning, dividing up your product lines or looking at a geographic area. Another way is a function to set up another company for the new marketing work that you're doing.
Wow.
Another company for management. They've got a structure doing the same thing, but in a way that reduces taxes.
See, that's the expertise that you guys bring. I'm like, wow, I'm already feeling this thing.
Yeah, look at your own business, Neil. You've got different lines of business. You bring different skills to the business. You're creating branding. You could easily slice and dice your business into different pieces, and we can send some of the money here, some of the money there. But here it's going to be taxed less than over there. Or it can grow.
Wow. Yes, especially like where I'm getting into the education side of things, and there could be some work with some foundation where there's just so many different opportunities that without having someone like you, Ed, or Martin,
right,
I'm going to miss out, and I'm going to be paying Uncle Sam.
You're going to be paying more tax than you need to, which is bad. But let's dig a little deeper. You've got financial goals. Business owners all have financial goals outside of their business. They've got a family. They've got charities they want to support. They want to buy a lake house or travel the world. Taxes are a headwind against all of that. So don't think of it in terms of some abstract, oh, I can save 10% on my tax bill. I can save $20 or $30 or $40,000 in taxes. It's What are you going to do with that money? Does that mean your kids go to a better college, or you give them a down payment for their first house instead of them having to wait until they're 42 or 39 or whatever the average age is of a first-time home buyer? Or do you want to retire 2 or 3 or 4 or 5 years earlier? That's where the real value comes in for tax planning. It's not just the dollars and cents. It's things that you can do with your limited time on this earth that don't involve work.
And Martin, you talked about the difference between a tax accountant and a tax strategist.
2 different things.
That I didn't know till today.
So the tax accountant will prepare a tax return for a guy who makes $150,000, and he'll say you're getting $2,500 back. He doesn't tell the guy that really had $35,000 withheld and he paid $32,500 in taxes. A tax strategist will say, stop working so much overtime, make $10,000 or $20,000 less, set up your own electrical contracting business, do $10,000 or $20,000 worth of work. You probably will end up with ways to shelter that money, saving between $5,000 and $10,000 per year. Ed's point is that adds $50,000 over 10 years plus interest to your financial security and your retirement plan and financial independence.
Yeah. So this isn't just about paying less tax. My whole business is built around helping people accomplish their financial goals with the minimum of interference from the IRS. Martin said earlier, we are financial advisors. If you pigeonhole a tax person as just a tax person, you're not going to get nearly the value you can out of your tax person. But the best tax person is a financial advisor who helps eliminate those headwinds from taxes. No, we're not the financial advisors who pick stocks or bond funds or ETFs for you. There are plenty of good people who can do that for you. What we do is we come in with the overall structure that helps you keep more of what you make through everything else you do. And when we get something like the big, beautiful bill, we're not just looking at how it affects tax returns. Right now, accountants across the country are signing up for continuing education classes on how to fill out tax returns under the new extended rules. What Martin and I are doing is we are looking for planning opportunities that have nothing to do with filling out the tax returns, but have everything to do with structuring better so that you pay less tax at the end of the year. That's a huge difference. And until you realize that difference, you're going to end up chugging along the old way, paying the old way, and doing as well as you did before, but you can do better.
And we are the CPAs, the insurance agents, the lawyers, the people who work directly with business in helping them solve business problems. And naturally, we help solve tax problems in conjunction with the business itself.
So, Ed, anything else to add with this conversation with Martin? It was such a great informational session, and there's just certain things that business owners should think about.
Right. We got bogged down in some technical details up front, but I think the discussion illustrates the point, which is this isn't just business as usual, particularly at the level in the profession that Martin and I have reached, that we're sitting down with clients and we're sitting down with the bill and we're looking for those opportunities. Martin, this is a great discussion. I hope you come back sometime.
Appreciate it.
All right. That was a special simulcast. Where can we find info on you, Martin, especially if they're in your area, that they can contact you?
I'm sorry.
Contact you.
Contact information for you.
Yeah.
My email is like my name, martin@eisenstein.com. I'm here in Secaucus, New Jersey, and you can Google me and find me pretty quickly. You can probably find me on Perplexity too.
All right. Sounds good. All right.
Thanks, guys.
All right. That was a special simulcast of the Neil Haley Show and the Lion Share podcast. Guys, take care.